As I'm recording this, crude oil just closed above $81 a barrel for the first time in months. Gold is hovering around $5,100 an ounce, and the Strait of Hormuz, the single most important oil choke point on the planet, is effectively shut down. And the most important part of this story is the thing almost nobody is talking about yet, because when they do, these prices will look cheap. Welcome to my channel. I am Bogdan Macro, and if these updates are helping you connect the dots in real time, hit that subscribe button and like this video so more people actually see it. Let's start with what just happened. On Saturday, March 1st, the United States and Israel launched coordinated strikes on Iran. Within hours, Iran retaliated with missiles and drones targeting Saudi Arabia, the United Arab Emirates, Bahrain, and Qatar. And the immediate casualty beyond the obvious human one was the Strait of Hormuz. According to Windward Maritime Intelligence, traffic through the strait dropped at least 80% within the first 48 hours. An IRGC commander went on the international distress frequency and declared the strait closed, saying any vessel attempting to pass would be set ablaze. At least 5 tankers have been damaged, 2 personnel killed, and roughly 150 ships are stranded around the waterway. Let me translate that for you. 20% of global oil consumption passes through that strait every single day. When it shuts down, it does not matter how much oil America produces or how much OPEC promises to add. The barrels cannot get to market. Helima Croft at RBC put it bluntly in a research note, saying the lion's share of OPEC barrels in the region could essentially become stranded assets in an extended war scenario. That single sentence should tell you everything about where oil is heading if this conflict drags on. Now here is the price action so far. West Texas Intermediate surged over 21% in a single week, closing at $81.01 on Thursday, March 5th. That was the biggest single-day gain since May of 2020. Brent crude settled at $85.41. According to AAA, retail gasoline in the United States jumped 27 cents in 1 week to $3.25 a gallon. The last time gas prices spiked this fast was March of 2022, right after Russia invaded Ukraine. And according to Goldman Sachs research, traders are now pricing in roughly $14 per barrel of geopolitical risk premium. Their analysts estimate that if flows through Hormuz are fully halted for 4 weeks, the impact justifies that entire premium. But here is the scenario most people are not pricing in. If the strait does not reopen soon, oil is heading to $100 a barrel and above. Bob McNally from Rapidon Energy Group, a former energy advisor to President George W. Bush, told CNN that gasoline prices nationally could catapult back above $4 a gallon if that happens. And the Trump administration has no timeline for when the strait will be safe again. Now, separately, let's talk about gold. Gold hit $5,184 an ounce on March 4th, up over $2,200 from a year ago. This metal blew through $3,000 in March of last year, $4,000 in October of 2025, and $5,000 in January of this year. Total gold demand in 2025 exceeded 5,000 tons for the first time ever, according to the World Gold Council. The gold price set 53 new all-time highs in 2025 alone. And the engine behind this move is not retail speculation. Central banks bought 863 tons of gold last year, the third consecutive year of historically elevated purchases. Poland alone added 102 tons and is targeting 700 tons total for what the governor called national security reasons. According to the World Gold Council's survey, a record 43% of central banks plan to increase their gold holdings in the coming year, and 95% expect global reserves to rise. JP Morgan projects around 755 tons of central bank buying in 2026. That is lower than the peak but still far above the pre-2022 average of 400 to 500 tons per year. These are not traders chasing momentum. These are sovereign nations making strategic decisions to move away from dollar-denominated assets. And that shift has been accelerating since the weaponization of SWIFT and Western sanctions in 2022. Now here is the piece that ties all of this together. It is not just oil, it is not just gold. The entire commodity complex is catching fire. Aluminum on the London Metal Exchange hit $3,383.50 a ton this week, the highest since April of 2022. That is an 8% weekly gain. Why? Because the Gulf region accounts for about 8 to 9% of global aluminum production, and those smelters depend on the Strait of Hormuz to bring in raw materials and ship out metal. Aluminium Bahrain, one of the largest smelters in the world, declared force majeure this week, suspending deliveries to customers. Qatalum in Qatar began a controlled shutdown after Qatar Energy halted operations at the world's largest liquefied natural gas export facility following an Iranian drone attack. According to ING, Europe gets roughly 30% of its aluminum imports from Gulf countries, and Qatalum warned that a full restart of smelters could take 6 to 12 months. Meanwhile, the CRB Raw Industrials Index is sitting near its highest level since June of 2022. Gasoline prices are climbing, agricultural commodities are reportedly next in line. Separately, each of these data points is interesting. Together, they tell you everything. Gold is leading, copper is following, energy is moving now, industrial metals are catching up, and agricultural commodities are waiting in the wings. This is how commodity cycles work. They do not all move at once, but when the dominoes start falling, they tend to fall in a sequence. And we are watching that sequence unfold in real time. Peter Schiff made a point this week that I think captures the core risk. He said investors seem to be assuming a short and successful war, and while that would be the ideal outcome, the probability is low. Once markets start to price in a more drawn-out and messy conflict, he said, stocks, bonds, crypto, and the dollar will be much lower, and oil and gold much higher. Now, I'm not here to make price predictions or tell you the war will definitely last months. Nobody knows that. But what I can tell you is what the conditions look like right now. The strait is closed. Production is being shut in. Force majeure declarations are spreading. Central banks are still accumulating gold at elevated levels. And the market, according to the options activity in aluminum futures this week, is starting to position for much bigger supply shocks. Goldman Sachs has already raised its aluminum target to $3,600 a ton, with a bull case at $4,000. If even half of these supply disruptions persist through March, we are looking at a very different price environment across the entire commodity spectrum. So here is my question for you. Do you think the Strait of Hormuz reopens within the next 30 days? Or does this drag into April and beyond? Drop your answer in the comments. I genuinely want to know what you think. If this breakdown gave you something useful, send it to one person who needs to hear it. That is how we grow this. Make sure you are subscribed so you do not miss the next update, because things are moving fast and I will be covering this as it develops. I will see you in the next one. Oh, and before you go, YouTube thinks you might enjoy this video next, so let me know if they're right.